All right, so we've got lots of other folks signed up. We'll see if they join us soon, but we'll get rolling here. So, how was your day? Uh, this is not one. This is not one that people necessarily expected because Friday nobody had heard of DeepSeek, unless they were describing maybe their own research process or something. For those of you who are new here, because we're going to open these to the public, for another couple of weeks, and I think probably second week of February, we're going to make it subscribers only. So we've got a couple more freebies, and then after that, have to be part of the group. And I will say this: there are 140 investing groups on Seeking Alpha. We are not the least expensive by far. We are not the most expensive. But I would say if there's one day like today can pay for a year of this service. And it's not because I am trading up a storm. It's what do they say? Prevention is the best cure. And part of prevention is always having a risk management discipline. It's like never having to say you're sorry, right? I've got all these old expressions. And here's another one: options and depth charts and tiers. Oh my, which is what we're going to talk about here. Uh, I'll admit it. I'm a fan of The Wizard of Oz. Coming up on 90 years old, something like that. This movie, and so I love using this line all the time: lions and tigers and bears. Oh my! I'm sure in Detroit they don't want to talk too much about the Lions right now. Sorry about that, you NFL fans. Uh, but a day like today, you can summarize it as follows. Uh, this is the Warren Buffett quote, right? Only when the tide goes out do you discover who's been swimming naked. Uh, I don't know what's going to happen after today. I don't know if this is another one-day blip. No idea. But it doesn't matter to me. I will say what will be the tip-off is if you start to hear about a phrase known as margin calls. Because when people are levered to the hilt, as they are, with all the crazy things that you can do with options. I don't do crazy things with options, but lots of people do. People try to take a $10,000 net worth and play like they're playing with a half a million. Uh, you know, that's great until it fails. I'm sure there's a lot of that in the crypto world too, but there's plenty in the stock market. Most people who use leverage, who use inverse, who use options, most people, unless they have a lot of experience with it, it's just a matter of time before they're going to ruin things. And if nothing else, I mean, I'm 30 years into that stuff, so it doesn't mean I make all the right decisions, but I tend to not make disastrous decisions. And so if there was ever an advertisement for what we are doing in this group and why people would want to stay in it if they're in it or be in it if they're not in it, uh, is this, okay? I am not surprised one bit about today. And all you have to do is look back to everything I've written for months to say, these types of days are inevitable. It doesn't matter that it was DeepSeek and that might screw up in video, whatever, okay? It was going to be something. When you're priced for perfection or close to it, as so many of these stocks are, it doesn't take much. I mean, if you are if you are not sure what the weather's going to be, okay, and you stand something up in the backyard and you say, well, as long as the wind doesn't blow more than 5 miles an hour, we're okay. It's just a matter of time until a 5 mile an hour wind or more is going to come by and knock it down, and that's what the situation is for a lot of people. I think this is where the responsible, serious investors get separated from the rest. So, look, the charts have shown this type of risk for a while. Today, that risk maybe started to come to roost, or maybe not. But if it's not today, that is the beginning of something bad. It'll be some other time soon enough. And so to me, it's like, why would you, if you are retired, semi-retired, or you just like the amount of money you've accumulated and you don't want to give a lot of it back because you work too hard for it, and this inanimate object called the market comes along and tries to take it away from you every now and then, and with so many people crowded in the same stocks, uh, that's how these things happen. That's how bubbles, manias happen. We never know when they're going to burst. Don't know if it was today. Absolutely no idea. Don't really care. I'm a technician at heart, and so to me, that is going to be a guide for when risk is high. Does that risk get realized? You can go years before it gets realized, but it's always nice to have it there. Sort of like the concept of life insurance, if you know what I mean. So, second thing about today, why option collars, which is something I talked about a lot last week. If you did not see that session, we did record it, and in particular, there's about a 25-minute segment where I really just go through this dog collar concept, which I'll talk about again today. And when you go through the option, the dog collar, uh, that to me is built for days like today. Because what if there's another one tomorrow? What if this one had gotten worse? I mean, I saw toward the end of the day, the tech sector was down 5%. The NASDAQ, if anything, down 3%, was spared because it has things in it other than technology stocks. So it was actually a bit of a hedge today. It always starts out that way. So I'm not predicting the future. I'm just saying I'm glad I'm a technician, and I'm glad I'm in a position here to be able to help others avoid disaster and pursue opportunity. Okay. Um, and look, the part that we normally cover in the service is my investment accounts. I have trading accounts too. I don't know how much they were up today, but a lot. Because again, when markets react this way or this way, as long as they don't do this, there are ways that you can profit from that. Not really a subject for today. If we really had lots of demand for Rob, can you spend a whole session talking about what you do on a daily, weekly, monthly type of trading basis on the side with smaller amounts of money? Gladly do that. Happy to do. Okay, so let's finish talking about today, and then we'll get to the broader topic. Why roar? If you don't know what roar is, I'll remind you or tell you for the first time. It's reward, opportunity, and risk. That is basically, to me, a way to describe the trade-off between trying to make money and trying to lose, trying not to lose. And I always say this, okay? Investing is shades of gray. It's not black or white. And so the way you prepare for days like today, not knowing when they're going to happen, is you look at everything as, if somebody says to me, do you think this stock's going to go up? I don't want to be too geeky and say, well, I think there's a 75% chance that it goes up 10% before it goes down 10%. So to me, that would be a starting point. Okay. That's how I think. That's how I think a lot of investors should think. And guess what? If you were watching in the chat or participating or just kind of reading the stuff, there's where a lot of this stuff happens in between these meetings. The chat is fantastic. Thanks to all of you who are asking questions, things like that. It's just a joy for me to be able to educate and inform through there. And I will always tip you off to what I'm thinking about doing even before I do it, because to me that's part of the service. I may not do it, but so you can always ask. And I've answered a lot of questions like that. So to me, okay, the next thing we're doing in the research here is trying to take this ROAR concept. I have this thing where I say, okay, take $100 every Tuesday. I will say uh, how much of that $100 right now do I think should be in the S&P 500 versus T-bills, SPY and bill. So the latest reading, it was as high as 40 recently, but it's down to 20. Why? Because I saw the risk going up, and maybe today was the beginning. Maybe it was another one-hit wonder. Uh, but to me, every security can be evaluated this way, and I'm going to do my level best over the month of February to try to come up with a bottom line system, not that says buy, sell, or hold. I think that stuff is absolute garbage. And my lord, the feedback on some of the if you want to see some of the biggest jabronis that you'll ever see, it's an old New Jersey word. Look at the comments on the AT&T article. Absolutely no perspective about what I just said. Uh, I mean, you can make money a million ways to Sunday in the markets, and that's without options. When options, you can 10x it if you want to, okay? But you have to understand, you have to engineer results. That's, I think, where I am different. My focus is on engineering results. Style points do not matter to me. So, yield at a reasonable price, and I mean, the service is called the Sungarden Yark portfolio, but yield at a reasonable price, the technical definition of it is it's a way for me to find long-term oriented contrarian dividend stocks. In other words, they are selling at very high dividend yields versus where they've been over the last 7 years. That's the exact definition. Okay. So as an example, let me try to think of one off the top of my head here. Okay, Boeing's probably not the best thing. Nah, Boeing doesn't even pay a dividend. Let's see. What is one recently? It's been a long day, as you can imagine. Okay, let's see. You know what? I'll get to that. I'll get to that in because I'm sure I'll come up with some examples here. Okay, but the idea is, when dividend stocks are yielding toward the high of their 7-year range and they start to come down, meaning the stock price starting to go up, that is a better signal than just saying, oh, the stock looks like it's bottoming. If the price is bottoming, but you also have the yield potentially peaking, very, very, very powerful combination. That's what I discovered. That's what we've got a trademark for. And yeah, that's one of the key components. So I'm kind of looking at take that long-term indicator, combine it with a short-term indicator, wrap options around it when needed, and it's a great 1, 2, 3 punch. I kind of described this in the chat. You go back and see it. And because really, like I said, no style points, okay? I would actually not mind. And by the way, if you have questions, you have tickers you want me to run through, the best thing to do is put them in the chat now so I can get to them in a little while after I walk through a couple other things. The more this can be Q&A, the better off we'll be. But this is a question I am asking myself right now. In fact, I think it's so important, I'm going to put red on it. So how much is stock picking really going to matter? And I would love any instant reaction that you have to the following thought that I have had. I am starting to wonder if going beyond the 30 stocks in the Dow and maybe another 10 others of my choosing, might even be from the Dow Composite, is that enough stocks? Because to me, they're all pieces of paper. And look, it doesn't mean that I wouldn't like to own them for a long time, okay? I mean, the one that we moved into recently, but with a collar on it, okay, was Apple. But I mean, look, after this run, I don't know. I don't know if I can own Apple all the way up to here over the next 5 years without trimming the position or something like that, or okay, or moving in and out of it. But my point is that I feel like the number of stocks that somebody tracks, it's only becoming a distraction because what you get on days like today, which turn into weeks, which turn into months, which turn into years, is a market that tends to move largely in sync in ways it never used to. Why? Indexes. Uh, and it's that simple. If you're not sure why I say that, let me know. Okay, so I'm now going to focus for a little while on options. And I actually wrote this whole thing out here in part as my own little mnemonic device. And but I will probably get this into a Seeking Alpha article very soon, or I will get it into a blog or something that can put it in your hand. So this won't be the last time you see this, and even if you don't see the replay. Okay. So what I really wanted to do is start to put together a primer for you all on how I look at options, how I use options, and the very simple explanation of what options are. Because if you tune into most subscription services or whatever, the famous Nigerian brothers, etc., from all the stuff that I've seen out there when it comes to options, I feel like um, it's not 5 minutes before they're talking over your head. And why do I think that? Because they're usually talking over my head. Okay. I mean, I'm just a middle class guy from New Jersey. I don't, I don't have, I don't need to speak in Greek language to understand options. Okay. No offense to people who know how to speak Greek. I just don't. Uh, so what is my goal for owning options alongside a stock or ETF I own? Stock and ETF are interchangeable here because, I might do this with SPY, I might do this with Qs, I might do it with any stock, I might do it with, I don't know, I was looking at my list today, what is looking at least interesting? Yeah, healthcare sector, XLV, maybe. I mean, no, I'm not committed to any of these yet. Um, uh, let's see, yeah, maybe China, obviously because of today's news, maybe consumer staples, although I own a lot of the stocks, maybe long-term bonds, we'll see. But I want to apply my best thinking structurally to anything that I might own, because the first step is what should I track every day? Okay, the more things you track every day, the more work you're going to have. So I'd rather not track too many things. That's why I said the thing about the Dow. Second, once I track it, which ones do I want to own now? And the next thing is, how do I want to own it? Those are the three things that just, wash, rinse, repeat. So I will, let me just walk through the rest of this here. It's not a slideshow, but it kind of works the same way. So what's my goal with options? I want to surround a stock to define my outcome. I'm going to talk in a minute about what they call defined outcome ETFs, which I'm not a fan of. I have a long history with seeing those things structured from way back in my brokerage days, like in the early 1990s. So I've been around that stuff. And my response to that is, you have enough money, you can build it on your own. Why do you need to pay somebody else to do it and go by their rules? You can customize it all the way through. And that's what I'm saying here. A customized, lower cost, no gaps version of buffer ETFs. I'll explain the gap a little bit later. Okay. Define the worst case. I'm all about defining the worst case. I want to first avoid big loss, then I want to make as much as I freaking can. Those are my two rules. And if the best case is reached, guess what? I can still, with a little more work, I can earn as much upside as I want. And the last time I checked, okay, and this is not some sales line, but the last time I checked, if I can define up front how much I can lose at the most, okay, if I can lose $1,000, no more, no way, impossible, okay, unless the market's all shut down, but that's a bigger problem. If I can't lose more than 1,000, but I can only make a few thousand, but then again, with a little bit more work, maybe I can make more than 3,000. 3-to-1 trade-off all day long for me, all day long. I'll take better if I can get it. I'll even take 2-to-1. But that's what I'm trying to do, and that's why I talk about engineering returns. Okay, so I'm going to do my best here, okay? And feel free to grade me, okay? But only if you're a really tough grader. Uh, when I finish the next probably 5-minute example here, if that, I want you to grade me on whether you are able to understand it, okay? And B, did I do it without using a lot of jargon, okay? Because this is what I am all about, and that's what the group is about. So I'll just walk you through it, okay? When I invest in stocks and ETFs, I take on the full risk of the dollars I invest. Quite true, right? Until you sell it, you know, if you owned Nvidia last night and you just bought it on Friday afternoon, as soon as the market opened, 1/8 of that money, okay, but wait, there's more. It was up to 1/6 of the money by the time the day was over. At least last I checked, Nvidia down about 17%. Okay, it's one day, but this is my point. All right, and people say, coulda, woulda, shoulda about this stuff, or that things will never happen. I always want to be protected against it. I don't want to have to wake up in the morning and have my morning walk messed up because I'm worried about what's going to happen at 9:30 when the bell rings. Doesn't mean that I won't lose money sometimes, but so what? It's one day at a time. But I'm trying to take out the worst case scenario is what I'm doing. Again, it's a very much like an insurance concept, okay? So I'm taking on the full risk when I invest. Whatever happens to that stock, I make or lose money based on the exact movement of the stock. So I'm constantly deciding, and this is me as a conservative investor, I'm always thinking about how much risk do I need to take to get reward? That is risk management to me. But that can limit the upside. Those of you who have been with me for a while, you know that I would tiptoe into individual stocks at these little baby 2%, even 1% positions, okay? Because I don't want to risk any more than that. And maybe when I made a little money on it, or if the chart pattern and everything else is just clear, earnings are not coming up to ruin it, maybe there's a dividend coming up going next day, that'll all factor in. But for the most part, I don't want to get myself into something where I will regret it because I tried to bite off more than I could chew. However, then you don't get as much upside, right? So like I say, okay, it limits upside, and I'm a conservative investor, so I'm always going to err on the side of caution. So a 2% position, even if I really like it, great if it works. If it goes up, 20% in a matter of 6 months, great. I've made 2% times 20%, I've added 0.4%. For every $100,000, it's another $400 that I've made. And you do this across a portfolio and it adds up, okay? But what if I had the guts, and I'm using that on purpose because a couple of people in the chat area, not the chat, that's us, the comment section of some of my articles, I don't know where these creepy people come from, but I've been called gutless more times in the last week than in my entire life. And I'm thinking, well, I don't know. I'm not the one with the profile name that nobody knows who I really am. So I think that's a little more gutless, but whatever, another story. Okay, but still, look, my whole career, I've missed out. I've left upside on the table. Okay, what I've never done is break. I've bent and not broken. Now, so I'd like to get more upside, but I do not want to just put more money at risk in order to get more upside. Okay, so If only there were a way, and those of you who are fans of the old Honeymooners show will remember a classic episode. I don't know if I'm getting too deep there, but okay. If only there were a way that I could buy 100 shares of stock, say it's a $100 stock, keep the numbers simple. So I'm going to invest $10,000 of my hard-earned money, and I'm going to get that stock, but I don't want to leave it there because if that stock were Nvidia, which who knows, maybe it's heading to 100. It that $10,000 would have been $8,300 at the end of the day today, and now it's getting emotional, and now I'm not very happy. It complicates my life, and who needs more of that? Nobody. So I take two extra steps. The first is I buy, you can call it I call it a ticket. I gave this example last week with my dad, and when he got drafted in the military, go back and watch that if you like. But technically it's a contract, okay? We're talking about an option here. We're talking specifically about a put option. It's a contract between you and I guess technically the exchange, okay? You don't get paired up with some other person. You're part of a pool, if you will, all right? And so with this $100 stock, that contract, that ticket, okay, which is a put option that I'm buying, it allows me to sell the stock at $95 anytime in the next 6 months in this example. Okay, I bought the stock for 100. Seconds later, I put in another trade. I bought put options at 90 that allow me to sell at 95. Okay, technically this would be, I guess, a July 95 put, and there's a phrase called buy to open, which means I'm starting this, I can sell it later on if I want to. Okay. These two are always part of the dog collar, as I call it. Okay. This would be what they call a married put, which is a really nice term. However, I can complete what we call the collar if I also enter into, and technically you are selling this. It's sort of like short selling, but with short selling, you have unlimited loss. Here, you do not have unlimited loss if you own the stock. The stock is your base, your backup, okay? Your underlying security. So you can sell another contract that forces me to sell at 115. Remember, it's $100 stock anytime in the next 6 months. Doesn't have to be the same date as this, but in this case, simple example, it is. Since I'm agreeing to sell for less than the full upside potential, okay, they'll pay me $4 right now, okay? I didn't mention here, let's just assume in this example, I can sell it at any time I want, my decision, and I can pay $6 for that, about $1 a month for 6 months. Okay, so a $100 stock, I'll go through the math in a second. All right, but if I want to defray the cost of this a little bit, I can bring in, let's say, $4, goes right in my account, cash balance increases, and I've sold a covered call option. If you ever wondered, because there's so much talk about this, especially if you're, probably over age 50, you've heard a lot of people talking about covered call options. Okay, so let's summarize. What did we put on here in this sample? Bought the stock, purchased a put, sold a call. You put that together, it's a collar. So what is all that dog stuff about? Well, it's, to me, I'm looking to do this most often when a stock has been hurt pretty badly, probably has a very good YARP score, going back to what I said before. Secondly, the ROAR score, okay, meaning it's a combination of the chart, and it's mostly chart based, okay? So not too much terminology, Rob. Okay, it is out of favor. It's down probably quite a bit in price. It's a high quality company, and there is reason to believe in the chart pattern, which is what I've been doing since I was 16, 44 years. Looks pretty good, but looks pretty good is not good enough for me. I mean, because I don't want to take the risk of just buying the stock on its own. In this case, I want to know that I've got a good chance of making money. And if I'm wrong, I'm not losing any sleep. Okay. So let's now do the math behind this. Okay. So this is kind of what I just described. Okay. Decent YARP score, attractive intermediate term chart pattern, and the Roar score is pretty solid. Okay, which is another way of saying, the chart doesn't look like speculative, like it's going to go up, but it could also go down. I see a lot of some of the best times to make money as a chartist are when it's a jump ball, a 50-50. It's going to be volatile in one direction or the other. That is not what I'm trying to do here. I want the odds in my favor. I want to feel probably like I have at least a 70 to 75% chance that it's going to go in the right direction. But having this little buffer underneath it, okay, through the put option and maybe the call option for the collar, is to me a way to engineer return, because you can do this over and over and over again. Then you just sit back and you know that on a day like today, and I'm happy to do this with an NVIDIA example if it will be meaningful to somebody after today, but boy, would this have worked well on NVIDIA today. That stock fell so much, you might have made money on the whole transaction. Okay, if you want to know why, ask me at the end. Okay, so let's do the math here. So the options cost $6 spent for the puts, brought in $4 for the calls because I'm giving up, potential upside in the next 6 months. So it cost me $2 net. Okay, so there's a net cost of $2. And again, the stock can go to $115 in a best case. Okay. Ooh, it's not a good color for this. Okay. Stock can go to 115 in a best case. So let's put one of those on it. And it can go in a worst case to here. However, it cost me $2 for the for the option combination. Okay. People say sometimes, well, do you have to do the calls if you already have the protector? Well, I mean, it helps me to the tune of $4 a share. So again, going back to the original situation here, $100 stock, call option at 115, put option below it at 95. In either case, it costs $2 to put me in that bracket, if you will. So 115 minus 2, 95 minus 2. If the stock goes to 115, I will be potentially, I mean, the longer it stays there, if it's there at expiration, okay, usually get called at the expiration. So 6 months from now, the stock is sitting at 116. I'm going to have to sell it for 115, and my account technically is only 13% better off because I paid this at the beginning. And you can play around with the options, interim, and all that stuff depending on where the stock goes, but that's not for today. Okay, and then what's the worst case? Well, if the stock goes to 50, I can still sell it for 95. This is the best feature of this to me because I'm a risk manager. So $95 worst case is really 93. And so in this simple example, and I have no idea why I put 5 here other than a typo. Okay, so this is where it all comes together. So we have, and I don't have a good color to spare here, so I guess I'll just use, boy, that's a bad one. Okay. I know I'm really particular about the colors. I'll just bold it. Okay. There. I can make 13% in 6 months. I can lose 7%. What I haven't explained, and I'll certainly go through some examples if you like, is this could be all, like, that can't be any number you want, but there is so much flexibility in this because there's a zillion combinations. They're all traded on the public markets. They're all every day. And like why our service? Why, pay me to help you out over the course of a year for, it comes out to $125 a month? Because I am constantly researching this stuff and I am kicking out 90% of the things I see and say, okay, this one. Um, and say, okay, I'm going to do this. Now, there's a difference between what I do with my own money, which is the portfolio. The goal here, and I've discussed this again in the chat with some longtime subscribers, and I think they've really helped me with this, so thank you all. I'm going to try to spend more time covering a little wider universe of securities so that when I get a good idea, it may not be something that I own because you can only own so many, but that way, if people ask me, well, what do you like? Somebody asked me about a railroad company. We'll go over that before we're done. I don't think he's on the call today, so I told him I would go over it so you could see it on the replay. I am going to look at that, and maybe it's not a stock that I want to own, but he owns it, so I can at least say, hey, if I were going to collar this is kind of what I would look at, and just help with the construction without giving specific advice on what to do. Okay, it's an educational component. Anyway, so how do we do with this? 13-7. Okay, it's almost 2-1. I like 2-1, 3-1 better. I invested $10,000. I can't make more than 1,300. I can't lose more than 700. Now, contrast that with if I didn't have the collar. The stock went to 80. Gee, that never has. Stocks never lose 20% in a day. Well, a lot of stocks have lost over 20% today. Okay, 10,000 would have been down 2,000 or more. But with the collar, again, I can't lose more than this. Does not matter what happens. The options exchange is regulated, and a contract is a contract, and they honor the contracts. That, to me, is why a lot of people do not appreciate the simplicity, or as I say, the meat and potatoes nature of options work and how you pair them with whatever you want to own, unless you are so certain of something, or you say, well, I can settle just owning 2% of this stock. I can show you in the portfolio now. I own some 2% stock positions. I also own a 6% stock position, but the 6% stock position I would never do without a collar. So of course I have a collar on it. Okay. All right. And then also, okay, last little point here, but a very important one, because this is what constantly I will get when I write articles for Seeking Alpha about this. I'm constantly getting the response from people, oh, but if the stock, goes flying higher, then you can only make 115. Why? I can't look, you can buy back the call option. That's usually not a good strategy. Okay. You have to look at it case by case. Okay. Yeah, I can consider it dead money, right? And, because the stock goes up to 120, you may not have it taken away from you, but until expiration. So if it floats up to 100, and I've seen this many times, floats up to 116, 117, nobody on the other side moves, and before you know it's back at 110, you're safe again. You've lost a little money, but you're safe, at least for until expiration. So there's no law against buying more stock or buying additional call options. If you do it with call options, again, let's say in this example, okay, I'm way up. I'm willing to spend, I don't know, another, $1,000, risk another $1,000 because if the stock goes to 125, I'll profit handsomely. Okay. And there's also a little bit of management if the stock zooms to 115 and, very quickly, but that's all, I'm trying to give you the general nature of this so I can get your questions. All right. So let's see. Yeah, like I say, this is all about risk management using options. I wanted to throw this in, just one quick note, because I do a lot of options work in my trading accounts. And again, not really part of the service other than I'm happy to show you anything that I'm doing. But to keep track of it would probably not sustainable. It can be a lot of activity sometimes. Uh, but there, it's all about the technicals and about events. Case in point, tech earnings are coming up. Uh, I might, and I mean, I will do this with as little as, I don't know, $100, $200, $400, something like that. Okay. And I will literally buy a call and buy a put. Let's say, I don't know, I guess, whatever, earnings of XYZ tech stock are coming out later this week. Well, there's a good chance, based on history, it's either going to go up 5 or 10%, it's going to go down 5 or 10%. And it's also possible that it could go way down and then go way back up. Had this situation in the portfolio with Target last year. It crashed for a day and it spiked up like another, I don't know, some double-digit percent. Well, if I had had little tiny, I did not on this, but if I had little tiny put and call options way out there, further, far from where the stock was, and again, this is partly playing around and partly, hey, you never know when you'll hit one. Okay. Um, uh, but small amounts of money, and if the stock goes up, one of them is going to make a lot of money, and the other is going to go down to probably head towards zero. And if the stock goes down hard, guess what? Other thing happens. You're only trying to take advantage of future volatility, and that's all that's about. Or sometimes I'll just say, you know what? Matter of fact, I did this with a little bit of Apple today. Okay, I bought like I don't know, Apple's at closed at 230, up 3%. I think I bought 240 call options like 3 or 4 weeks out, something like that. Okay, and I did it earlier in the day and right up. Okay, instant profit. Doesn't always work that way. You run a portfolio of these, or you just do it to learn, which is a big part of what I do. Okay, this is how I taught myself beyond what I already knew about options. Okay, I'm just going to give you a quick example now, and then we'll take questions for what I would call the hype. Okay, I think covered call writing is a really good idea. I do it, but doing it in isolation means you get that bad part about if you're successful and the stock goes way up, but you have no downside protection other than what they paid you. So going back to this example, where, let's see, okay, if I don't spend the $6 on the puts and I bring in the $4 on the calls, that's great income, right? Fine. But if the stock goes from 100 to 80, guess what? My stock is now worth 84. I don't feel much better. Okay. And people say, well, you can do this over and over and over. That's great. It all works out until the first time they blow earnings or something comes out of left field, like today for a lot of stocks, and then it's then you're digging yourself out of a hole, and I have no patience for that as an investor. I will take lots of risk with really tiny amounts of money in my trading accounts, but in the investing accounts, it's all serious business here. Okay, so covered call writing, like I say, it's a great idea, but it's incomplete. Why is it incomplete? Because you've got that huge downside still. Okay. Now, I turned everybody on in the group, several months ago to the Yield Max ETFs. If you're not familiar with them, there's a whole set of them. I think there's probably 40 or 50 of them now. I mean, I'm kind of familiar with some of the people that are tangentially involved, which is how I was kind of an early adopter, because I was able to get the manager on the phone and talking about that. But what these do basically is they say take a stock, usually the more popular stocks, all the Mag 7 are part of this, and using options. They don't actually buy the stock. They use options to simulate owning the stock and simulate selling options against the stock to bring in a ton of income. And it all works out great until, and I'll pull this over, okay? So today was a rough day for NVIDIA, right? The poster child. Okay, NVIDIA was down 17% today, okay? Well, what about, and I don't even know what this was, but I have a pretty good idea. This is the one that would pay you, I think it had in the last 12 months, it had a yield of like 40 or 50% because the stock went up and it's so volatile and the whole thing, okay? How about that? Okay, so I think I have my next Seeking Alpha article, or a future one anyway, okay? Zero protection on the way down, okay? I rest my case, Your Honor, from everything I said the last 20 minutes. That's why I don't like, and that's not even just covered calls, okay? Those funds, that fund is like 90 something percent T-bills. But as the manager explained to me, it doesn't matter, okay? And yes, those of you who saw that I was doing a lot of work on those things, I always said my concern is if something happens to one of the stocks. We still own or I still own the portfolio, the ones on this for Amazon and Google. Okay, now Amazon and Google didn't get hurt as badly today. And as somebody had asked me, well, what would you do if you had one of those? Well, to me, my decision now is, and here, let me bring it up. I will use this one, Google. Okay, so Google was down 4% today. First glance at the chart, looks like, another day or two like this and it'll be gonzo. Okay, and so how did, easy symbol to remember, GUI, okay? This is a little more normal case, okay, because it wasn't quite as volatile. So it was down 342, 3.42% out of 4. That's just about on spot on. It's supposed to go down about 80%. When doesn't it? When you really wish it only went down 80% of what the stock did, not 100%, like NVIDIA did today. So to me, options are great, but if you don't really understand how they work, then you're likely to have a sugar high until something goes wrong, and then you will say, I'm never using options again. What I'm trying to do in this service, and it's becoming a bigger part of the service, just ask the existing subscribers, is try to figure out where can options be used to take the risk out of taking risk and define worst case outcomes and try to preserve as much upside as we possibly can. And there's an infinite number of ways to do that. Okay, finish up on this, then questions. That's yield max, okay, you get a lot of income, but again, it's kind of like, sticker shock, right? It looks great. It looks great when you're getting a 40% yield, okay? But if that's only because the stock's going up and it's volatile. Those are the two things that give you all that income in some of these things, okay? I was very well aware of that from the day I bought the first one. But the market is not as friendly anymore. And so, and by the way, the other thing, this is one of, I think, the questions that somebody asked that's not here. The other thing you can do, okay, let's go back to that NVIDIA example for a second. What if I owned NVDY and it fell just as much today? However, I had also owned, I've got almost every part of the collar except for the put option purchase, the disaster protection. If I had spent a little bit of money on that, I would not be down 17% on that NVIDIA position because the NVDY Yield Max ETF plus that little ticket that allows me to sell NVIDIA at a certain price, whatever, hypothetical, would have offset some amount of that. How much? I could have game planned that in advance, depending on how much money I wanted to spend on the protection. Again, kind of like term life insurance, except the term could be tomorrow. All right, and then there's this thing called buffer ETFs. Be careful of this. This is stuff I used to see them create on Wall Street before there were ETFs. They used to do it in private placements, things like that. Okay. Again, great until something very bad happens. This may be one of those cases where the market and especially the Nasdaq, the biggest issue for them may not be fundamentals. In fact, I don't think it is. I think the biggest issue is leverage, margin calls, speculation, and people like the Warren Buffett quote. For those of you who were a little bit tardy today, okay, Warren Buffett's quote: "Only when the tide goes out do you discover who's been swimming naked." I think we're going to find out there's been a lot of skinny dipping going on in the trader community and in the newbie investor community. And because this is what happens every single freaking cycle, and it's what happens at the end. And it is why if we get more days like this and they turn into weeks and months, more than the flash crash, let's say, of 2020, a little more like 2022, where it goes on for 9 months. If we get that, I go from days like today where, let's see, S&P was down 1.43%, YARP was down 0.15, okay? You're down 0.15, so about 1/10 of the market. I'll let that happen for a little while, but then I'm going to try to do things so that if that keeps happening, I want to make money, because I don't take a time out from trying to make money just because the market stinks for people who only know how to buy stocks and nothing else. You know, number go up, right? Okay, so these buffers, okay, the issue here, and I mean, here's here's a good example. Want to get confused? Okay, this is the biggest one. It's got over $1 billion in it. There's a ton of these now. Okay, seeks to track the return of the S&P up to a predetermined cap. Okay, so just like us, except they're determining the cap, and they buffer you against 15%, the first 15% of losses. What's missing? Well, if Nvidia goes down another 17% tomorrow, you're already past the first 15. Okay, you're getting all of it on the way down. Okay, all right, and then they'll reset it, etc. But then you get on in all this funky stuff. It basically said something in here about how like the cap was like 7% or something. So that's great. They'll promise you no downside, but if your upside is 7 or 8%, aren't you better off customizing this yourself? So, they say, oh, okay, whatever, the fund is up 1.2, you still got, I guess, I don't know, whatever, 10%. This is one example, okay? It's, they're convenient, but they do not prevent all loss. Okay, and so these are great unless you get an extended bear market. Okay, all right. I am going to stop there. I'm just going to remind myself of what these are. Okay, CSX talked about. Oh, yes. Somebody asked if the yield max ETFs are in trouble. I think I just gave you one example of how they could be. As far as the ones I own, I mean, everyone's it's case by case. I would say it's a little more nuanced question because of the price of the stocks. And I'll show you what I mean by that, because I have a feeling other people may, since you're following my portfolio. Okay, so let's see. Google. Yeah. Okay, Google's $200 stock. I may just decide that, hey, you know what? I'm happy with GOOY, but it's a lot to own 100 shares, $20,000 to own 100 shares of that. So, I could break this down, say I still like the stock, and buy the stock outright, spend $20,000 on $19,000 and collar it, or I can say, let's leave well enough alone. I'm just going to buy a way out of the money put option. I'll be a little bit over hedged because I probably don't own 100 shares here. So again, a little bit too much nuance for now. I can answer it more specifically if somebody wants. There's a better chance that if this lasts more than a couple of days, I may show this one the door, because there's too many other options out there, and I don't even mean options in this case, I mean places to look. Okay, let's see. Yeah, this is the one on Microsoft, the other one. Okay, and this one's hanging in. This one's right at kind of the trend line here, so too early to tell. Yeah, I'm not going around hunting looking for others just yet. And let me see. Yeah, adding puts to complete a stock position. That's kind of what he asked, and that's what I was just describing. Okay, so we've done that. I'll use CSX if we have some time. If not, I'll spell it out. It's easy to do examples of these. Okay, we are exactly at 1 hour. I want to use the rest of the time to answer your questions, and let's start with the chat. Okay, and let me do this. Move this over. Okay. Opinion on, actually, I'm going to do this instead. Let's see if I can do a different share here. Let's share this one. We see the chart now, right? We should.
Not yet. I'm still seeing the document. There's the chart. There it is.
Oh, okay. Okay, good. A little bit of a delay, I guess. Okay, good. All right, so let's see. What are the genuine parts? I've flirted with this one quite a bit, but have not owned it. Okay. Well, I'll tell you what. And this is, more of a pure technical. So what I normally do, I don't want to get all the way out to a weekly because it's, a lot has to happen for a weekly to move. So I usually will look at something like this when I'm getting close to buying. So what I like about this at first glance is right there. Okay. You've heard me call this a dolphin's mouth or something like that. Okay. It looked like this is a momentum indicator called price percent oscillator. I write about it a lot. I can talk about it as you wish. Okay. I see that there's it is trying to peek its head up here like a baby bird trying to crack out of the egg. Okay. But it's got to get above there before I take it seriously because it can fake you out just like it did with this. Generally speaking, I don't trust any stock right now, not a single one. That's why lots of the option collars, and that is also why I only own 7 stocks right now. So, some ETFs and options work. Now, I'm also looking at this because my first line of offense, if you will, okay, not first line of defense, my first line of offense is I want to see this moving, and I want to see this yellow line, which is the 20-day moving average. I want to see it start to make a more earnest move higher. You kind of have to go back to here in the chart to see what I'm talking about. You see how in the lower part it crossed above 0, and in the upper part it kind of chopped around here and then started to move higher. So again, this probably never would have looked great to me, but if I were going to, let's say collar it, okay, maybe I would have looked to do that around here somewhere and it would have worked out okay. The problem I'm having with most stocks right now, and everybody's time frame is different, is I think you can do this all day long. Maybe not today, given where things are, but like to me, I think you have a much better chance at having this stock go up 10 points and then come right back down 10 or 15 points. And that is what I dealt with all last year. It worked out very well because I was nimble, but I don't want to have to be that nimble all the time. And I don't think anybody in the service does either because they're really like, oh, Rob didn't trade today, it must be a holiday or something, right? It's just too much activity and people don't, I get it. That's why I say it's like if somebody wants to talk to me about trading accounts or have me, give an occasional recap of what I'm looking at, I'd much rather do this based on the securities than the positions. Again, I'm not going to take any portfolio stuff away from anybody. I'll keep what we have, but I will tell you, it is much easier to talk about names and talk generally about how I view it. And that's why I'm going to come up with a Ruhr score and put it out there. Because if I can say, so for instance, okay, just top of my head, high quality company and passes all those tests. Okay, out of favor, great, but it's a long way from being, what I would call, a no question buy candidate. Okay, I mean, this is what's happened to a lot of these industrial stocks. This is sitting not too far. What is it, up 10%, other than the small dividend? It's up 10% in 10 years. That's 10% total. Okay. Um, this is this is the case. This is why I'm looking for these things. But frankly, what I think is more likely to happen, and I'm using not just GPC, this is what I see across the board. It's a great example. So thank you for bringing it up. Okay. Here's what I see with GPC. I see the possibility in my technician brain that somewhere between here and let's just say, okay, let's say here. Let's not get too gloom doom here. Okay. But I can see probably 400 of the 500 stocks in the S&P 500 doing this type of face plan. Okay. Why? Because of all the stuff I talked about before, the technical factors, the way that people are leveraged, the coming down from the bubble. Okay. And so, as much as I like the collars now, I'm also looking forward to maybe seeing a bunch of stocks do the equivalent of this. Okay. If this falls another 20% down here, and now obviously there's lower levels, I can point to them. Okay. But, like to me, it's like, it's still kind of early. Okay. And I'll show you one other line on here because it caught my eye. I'm just a shameless technician. I see this and I see this. Hopefully over time, people will start to see that. I'll get rid of these because we've already talked about those. Okay, so that's the other thing I'm kind of looking at here. Is this an uptrend or a downtrend? It's a downtrend. So what happens in a downtrend? It comes back and then I mean, don't take my word for it, okay? Except for a couple of, I would say there's two parts to this downtrend. Okay, there's the ugly part and then there's the really ugly part. And I would define those. And granted, it's not like it's touched 4 or 5 times, okay? It's not quite as hardened, okay? But I think investors are kidding themselves if they don't think that algos and hedge funds don't look at this stuff all day long. Like I said before, I mean, I was a technician for 40 years until it finally became more than just very useful. Now it's almost essential. And that's why I'm trying to teach people. And yeah, that's why I think 1,500 a year, is not bad to try to learn that, because if it saves you that much heartache over the course of a year, then, it's more than paid for itself. So that's what I see here. I see one little shelf here. I see another one here, but it's all going in the downward direction. And so if you wanted to make money, and again, this is just such a classic example of what I see, so I'm glad you brought it up. So, and I'll have a little tool where I could do this, but let's just do it in dollars, okay? From this point forward, this is when right when the rally started. This is when the AI rally, well, a little before then, but this is when the AI rally started. But before then, we had this, okay? So, from this point forward, the stock goes from 140 to 186. Great. I think I'll be a long-term holder. Oh, terrific. Well, now you're down to 145. Oh, now look at that, 145 to 170. That's not chump change, right? Okay, 170 down to 126. All the way back up to here. Any one of these, you could have gotten, I don't know, 2/3 of the move, and wow, you would have had a great return on the stock that is down over this period of time. This is how I use technicals. This is why I like to rent and not own, because too many stocks look like this. And so that's that. Okay, let's get some other questions. Okay, let's see. Look at LHX. All right, now I've already given you kind of a whole dissertation on one stock. So let's see. Does this one look a lot like it? No, this one looks better, but let's see, somewhere in here. And this is another one that, I mean, I've looked at it, but I haven't really seriously considered it. Uh, there's an old expression among technicians, support becomes resistance. And not my rule, but if the algos and the traders and the hedge fund people are doing it, we should know the rules, right? Um, so, uh, this was support, okay, technical term there, right? It rested here a bunch of times before going higher. Just means there's a lot of people probably that had, money involved there. So now you'd have to see it go through here. I have not seen this cross into positive territory. I'm also only looking at one time frame. I look at 12. And I've automated some of this. Okay, so look, this was either, I guess, an earnings reaction, or maybe it was a Trump won the election reaction. I'm not sure. I mean, your defense stock. Um, so I guess what I would say is, look, in a market where everything looks suspicious, uh, this is not the worst. This is actually a pretty decent place where I'd say, if I were going to own it, I would definitely want a collar on it. I would try to make it so that I can't lose more than about, down to here. And I mean, I can get all the way, I can get 20% up before it really starts to get nosebleed territory. So, wash, rinse, repeat. The weekly chart is a little bit like that hasn't committed yet. It's kind of like saying, I'm falling, I'm falling, I'm falling. It's kind of like your ball club is in a losing streak, okay? It's lost 8 in a row. Then it wins 4 out of 10. And then it wins 5 out of 10. Would you say they've turned the season around? No, they're less bad, okay? And this is less bad. That's what that is. And it's actually supposed to be 3 days, okay? But the 3 day tells me getting a little bit closer. So look, I mean, you're taking a bit of a shot here because the stock has just gone up 10%, very quickly, and it's going to be influenced by defense and the whole thing. So, that's my read on that. Okay, let me see. Wondering why the stock price is slowly deteriorating. LHS slowly deteriorating. Well, yeah, it's not too slow. The other thing that I do, I mean, I'm not just a technician, it's just my bottom line. But I tend to think that so much of stock analysis now, they're all getting grouped together. So in the case of this one, I'm a big fan of the Seeking Alpha grades. It's still a very profitable company. It's not growing a whole lot. Yeah, but so much stocks are impacted so much now by things that have nothing to do with those stocks. Okay. If there are a bunch of people piling into one of the defense ETFs, and this was a big position in it, like, I think this is one. Let's see. No, it's not that big. It's a little small than some of the others, okay? But again, this stock could be rising because a lot of money is flowing into these ETFs, and so these guys are getting the most of it. I mean, I guess I would ask the question, how far can this stock go without these stocks also going? And that's why these days I'm just as likely to see, gee, if the liquidity is okay, I might even buy options or do a collar on something like this as opposed to the individual stock, because then I'm getting the basket and I'm getting a little bit more, protection. Okay, a few more. Let's see. And if I didn't answer your question completely and just talked a lot, then let me know. Market rebellion within Jerry and Brothers is a difficult one to stick with. Yeah, I full-time market watching and tried and left. Yes, this is why I'm going the collar route in part, because people don't have to worry too much about, I want to make this so that people can be as active as they want, or if they want to look at it for an hour or a week, they can do it. And frankly, 6 months ago, we were not in that position because all stocks had too much risk. It's the nature of the market, and I like to evolve. So let's see. Okay, somebody put great. Somebody loves the dog collar concept. Great. I'm going to be writing about this in Seeking Alpha. They were nice enough to ask me to be one of only 2 people to, when you see them start to promote their dividend webinar. It was going to be an in-person thing down here in Florida, which would have been cool, but they're doing a virtual. I think it's on like the 5th of March or something like that. And it's just me and one other speaker, so that'll be pretty cool. I'm very, very happy they picked me for that. Let's see. Bang Zoom. Okay, I'm not sure what that was in response to at 4:30, but I'd love to know. Okay, working with Dow 30. If you're working with stocks that are part of the, let's see, part of most of the market capitalized indexes is Dow 30 is you can you find a good roar score in this environment? Will you need to cast a wire net? Okay, let me, few different things wrapped up in there. So what I am aiming to do is to focus on the Dow, which I track all the time right here, but not the Dow as an index. Okay. Now look, that said, okay, just again a little bit extra, but one of the reasons you're not going to see me doing a collar on any of the stocks at the top here, and this is in part because of feedback from subscribers saying, geez, you need $100 to buy one option contract. That's the equivalent. One option contract equals 100 shares. Well, 100 shares of the Goldman Sachs, as they used to call them, is $63,000 today. Okay, I mean, if I were to put $63,000 in a single stock, like it better be all upside, no downside. Okay. And so I would prefer to stick with, the stuff down here and some others. Okay. Look, most stocks are, I mean, you can collar anything, but I'll probably be collaring some ETFs. Look, it doesn't have to be that complicated. When the market goes up and down together like this, and you can see, I mean, I have this one. And there's a few others in here, but they tend to be this part of the Dow. I guess what I'm saying is if I'm going to buy stocks outright, it's kind of amazing to think of it, but people say, oh, well, the Dow, it's got this price weighting thing. The article I'm working on, hopefully for tomorrow in Seeking Alpha, if you look at the Dow the way you look at the S&P 500, where it's based on market capitalization, NVIDIA, Apple, Microsoft, and Amazon, even after today, these stocks are like almost 60% of the Dow on a market cap basis. So the S&P is the one that's really screwed up because the Dow at least have some semblance of order still where you don't have so much of it, because it's based, they weight it based on this. Goldman is the biggest. Goldman has a 15 times bigger weighting than Verizon. That's not great either. And look, in my portfolio, I start with equal weighting and then I decide if I'm going to overweight or underweight. So anyway, let me see. Okay, it won't be just Dow, but it will be kind of Dow, oriented. Okay, because I just don't know if there's enough value. I mean, look, Genuine Parts is a great company, but I could probably, if I went through my watch list, I could probably find you 5 more like that. Okay, that all look the same, and they're probably all part of XLI, which is the industrial sector. Okay, let's see. I understand the option scenario, but can you explain how you can exercise the option before maturity date doesn't work the same way with the stock that you have to have a buyer? Absolutely not. And that's a good thing, right? It all goes into a pool. That's what they have market makers for. Is no different than saying if I bought 100 shares of Apple, I have to come back to that person. And if the stock goes down and I want to sell it, well, what if they don't want to take it back? It's not like your primary residence. Okay. You can't have a contract with a buyer and then it's up to the buyer to go through with it or anything like that, okay? It's a big pool, so you're not matched up with somebody else. You're just matched up with somebody else at that moment. And one of the things that I do, again, actually, this is a good way for me to at least give there. We see the bar chart screen, right? We got the bar chart screen now, right? I just want to make sure the technology is
Yep.
okay.
Yes, it
Okay,
is.
good.
Yep.
Okay, so I set up a filter here, and once I have worked on this a little bit more, and the portfolio is at least initially complete, what I'm going to try to do is to anybody who wants, I'll just give them the parameters, you know, I mean, because this is not the only one. I'm sure, you know, Schwab has one. I mean, you know, it's probably very common. There's just very good, very easy to read. So what I do with this is I put in things like, okay, I just want the Dow, you know, for at least for here. Hey, I don't want to lose more than $10 a share in any case. See, so what it'll do is it'll come up with all kinds of things. Come on, get that out of there. Okay, so I can literally say here, all right. These, and again, these are random. It's all different combination. I haven't looked at it yet, but let's say it was Boeing we were looking at. Okay, um, you know, I could go all the way out to December. Take this first example, and before I even look at the details, all I know is, okay, this is all I care about. How much can I make? How much can I lose? Oh, okay. So if I buy 100 shares of Boeing for $17,500. You know, I can make $2,200, or I could lose 800 for every 100 shares I own. Can't do any better, can't do any worse, because it's factoring in if the stock goes to here or goes to here. Okay, this is the more interesting looking example of what I did on the sheet before. Okay, yeah, you're paying. This is the call and the put. So you know you're paying $17 a share. Again, this is not a great example, but whatever. You're paying $17 for the put, uh, but you're receiving $14.45 for the call. So it's costing you $3. It doesn't necessarily matter that much to me if these numbers are 4 and 7 instead of 14 and 17. It's a net to me. It's $3 out of pocket to do this. Okay, so what happens when the stock gets closer? Again, this is almost like a whole explanation in itself. But as it does get closer to there, what'll happen is, okay, let's say it gets closer to 200, the options will, okay, this call option will hold, you know, will I guess shrink in value. And again, I'm so used to working in the net. This value will go away. You know what? It's going to be better off when we have an actual live example. Okay, I'm sure you can read up on the theory because it works the same way every time. But the closer you get to the 200, my preference is probably going to be to say leave the option alone. And if I really want to get more upside out of Boeing, I will buy a call option on Boeing. Maybe it'll be very short term. You know, if I've got a month left on this, I'm going to buy a 1 month call option. Maybe I will buy a small position in ITA, the ETF I just showed you, because they're all going up together. There's a lot of factors. And again, this is, to me, the role. I'm not advising anybody like I did for 3 decades. Okay, personal advice, not here, but I can at least figure out how to eliminate a lot of the really bad or like situations where, oh, I didn't realize I was taking that kind of risk. Okay, and just to so you can see, this can be go the other way too. Just show you concept for now. You know what this means? Okay, This means that I'm actually going to receive more for the call than I pay for the put. Okay, I can probably even run these. That's what's called a credit collar. Okay, let's see, where is my downside? There we go. Okay. All right. This is, let me see here. Yeah. In this case, and again, I wouldn't do it, it's too tight. Okay. I could do this and say, all right, my upside's 11%, my downside is 0, except I paid $7. So $7 is I could basically lose this and that's it. Because my strike price here on the put option is 175, and that's where the stock is. And sometimes when I build these, the math just works out that way. You know, I'm paying to protect myself below where it is right now, and that is the downside of the strategy. That's a case of it right here. Okay, let's see. I have a trading account. In the art portfolio, do you specify when a trade is? Oh, I don't even include the trading stuff in here. Don't even, like, just not part of it. Okay. What I had thought about doing, and again, it would have to be a trade-off because, you know, the portfolio aspect of this, and let me bring this over and show you what I'm talking about. Okay. Here we go. All right. So for those of you who are not part of the service, this is what it looks like on the inside. Uh, the Okay, I keep something called a depth chart. And again, one reason I want to keep the research simpler is, you know, I don't want to have too much here. It just becomes a lot of maintenance, and you know, we want to focus on investment decision making. Um, so in this case, okay, what I'm really doing is I'm saying, okay, these are not my trading accounts, but in either of the two portfolios here, the regular YARP portfolio, or as an example, I still like the transport sector, including the defense stocks generally. I own this in the all ETF portfolio, which is over here. I don't mind showing you this because they'll change often enough. It'll be stale very quickly. Okay. And really, this has become a very small community. Okay. And I think, you know, I like keeping it that way. Don't need to own 30, 40 stocks in a market where they all act the same. I've also got a huge slug of cash. But this is what we show people generally. Here, you can see. Okay, I have collars on these three, this one too, but I have collars on these three, and I added this feature in the last week to show you everything I just did. So again, with our Apple example, okay, nice that Apple went up today. I have a 6% stock position. When I don't know exactly where it closed today, whatever, 230 something, okay. I can get up to 260 before I have to maybe make a decision. When I get to 260, I'll walk through that. Okay. Right now, there's too many variables to say what I would do. I just know what my options are. Can't do less than 220. Okay. Maybe there will be another contemplation when we get to, if the stock gets up into the 250s, I say, wait a minute, I don't want to lose money all the way down to 220. But this is why I'm using my charts with this. So if Apple had earnings tomorrow and the stock was at 250, believe you me, I would do something to make sure I didn't lose it all in a day, like happened with Nvidia and some others today. Okay, so there's little nuances here. Okay, it can be a little bit of extra work, but I would rather do this and define where I am. So it goes out to here. I'm reminding myself that it cost me $8. So net, this is the best and worst I can do on the stock. So again, if the stock goes to 250, I'm in danger of getting called, but I also am way above my low. And so that might prompt some kind of action. One of the actions could be, oh, the stock's at 250. I can net 242 by just unwinding the whole thing right now. Because the options aren't worth anything because the stock is in between these two. Okay, again, stock's at 250, let's say. these have, I mean, they have value. The closer you get to expiration, they will both turn to zero value, because what is it worth to be able to buy the stock at 260 when you can buy it at 250 in the open market? We're zero on this date. That's the idea. What about this? Well, if the stock's at 250, how much would somebody pay you to say, hey, right now with a day left, okay, I'll give you this ticket that allows you to sell at 220. I can sell at 250 in the open market. So if it's between these two, as you get closer to expiration, the only thing that matters is that you're getting closer to expiration. These options are going to both be worth just about zero. And the closer you get to that, okay, I could look at it and say, all right, well, how much value is still left on the options that I spent $8 for? So if the stock goes 250, let's say there's $3 left in the options. I can sell it for 250. I can get another $3 back, so I lose 5 on here, and I net 245. Not bad for a stock I bought at 222 or something like that. Okay, this is going to take more spreadsheeting from me to be able to show different examples, and I think what I'll probably do next week, if popular demand, or there will be some session. We'll just go and we'll take what we did here and last week. Hopefully everybody will watch the replay if they haven't. And the next part of the course, if you will be, okay, let's throw some numbers in here. And what I'd love to do is maybe do one of these, I don't know, at like noon one day during the week, and actually walk through and put a couple, I might do it in my trading accounts just as an example, okay? But to actually go and research some of these live with you, ask questions, tell me, Rob, you're making a mistake, don't buy that stock or whatever, okay? We'll all be part of it, and I'll use some of my money to go and do it. That's what this group is about. It is an investing group. It is not a subscription newsletter, okay? All right, let's see. Okay, yep, Apple earnings are on Wednesday. I am very well aware of that. It would be awesome. Oh, what I just said. Okay, so we have one vote for awesome. And oh yeah, the noon, yeah, the noon session. Absolutely, yeah, we'll mix it up. Look, I will tell you, if you're in the group, thank you. If you're not in the group, I don't know, the 1 or 2 sessions like this, and we're not closing the group down, but we probably will close these sessions down. Maybe once a month we'll do one for everybody, because we kind of want to move ahead with being able to speak specifically about, stuff that I am doing. Okay. One other quick question for you, and then we'll close up unless there are other questions. So I created this. Nobody's really asked about it, and that's fine. Okay. I think it's a neat little concept. I think it adds a little value to the subscription, but we've actually thought about maybe just doing this on like our Substack or something, charging a few dollars a month, so that it's, if all somebody, but what are these? These are mini portfolios, okay? And one thing I said before about how, so many stocks move in sync, there's not a lot of alpha to be added, as they say. A lot of this will prove it, okay? I would not be surprised if, other than the more sophisticated stuff that we do in the service, that these 4 portfolios, each of which are simply a trade-off between 2 ETFs. I talked about this, the main roar score, 20 SPY, 80 bill. Tomorrow I could change it. I could change it to 0, I could change it to 10, I could change it to 50, okay? And then I will take one of my accounts and I will bring it in line with that allocation. It's just, instead of stocks and bonds, it's more useful combinations. This is Dow and NASDAQ, because sometimes they go in very different directions, okay? Maybe at this point, maybe the NASDAQ's going to crash and the Dow is only going to fall a little. Well, I would want to have more in the Dow. I might actually be able to make money in a down market. Same thing with this, which is kind of this, but I'll be interested to see how this did. I'll report that to you guys. But this is kind of like one of those yield max ETFs on the Mag 7, and this is a triple inverse Qs. Okay. I trade this a bit because it's without using leverage, spend a smaller amount of money. And this is just like I say, blue chip size matters. This is top 50 stocks. This is the inverse S&P. So it's kind of playing, the better that the top stocks, very top stocks do, the more I'm going to want to own of this. The worse the market looks, especially at the top, the more I can hedge. So I'll probably make a couple changes these. My question to all of you that are subscribers, or if you're not, but you're curious, is this, do you get any value out of this? Because, like I don't want to fill this shared sheet with a lot of useful information compounded by a lot of information that isn't useful. And, if you like, open your mics or whatever, and if you have any questions, that's the last thing I
Yeah,
wanted to.
I think it's interesting. I haven't really put any money on it yet, but I've got another pot of money. I was thinking of using this for some. So,
Yeah,
so
this
I
this this would effectively be, and I mean it's for everybody. Okay, it's not going away from the if we offer it to any outside the service, we'll be offering this service as we'll do that with everything. But as I see it, uh, if somebody were brand new, it's like I've heard these EFTs. No, 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 it's ETF. If it's like one of those conversations, well, maybe they don't want to get into a group like this just right away, okay? Or maybe they do, but they also want to have a little out, okay? This is the simplest out I can see. You literally could just invest in these two, okay? Oh, my kids, my grandkids have accounts. I mean, this is what I do. Okay, I have 3 kids, 2 sons and a daughter. The son is in the industry. Probably doesn't need too much of my help, but my daughters are not. So I kind of run their portfolios with an offshoot of this at the core. Um, but there's other interesting combinations, and here it's like, okay, you just have to track, 4 different pairs and look at it once a week and decide if it should trade off. And so to me, it's very easy portfolio building blocks, which teaches people how to be tactical investors, without
yeah,
some hidden risk there. That was the
yeah,
whole idea.
yeah. I'll certainly keep them from getting in trouble, right? If you're with the spy saying instead of going 100% stock, you tell them, hey,
Yeah.
it needs to be a balance.
You
So,
can you can only get in so much trouble, right? You'll never
yes.
make or lose more than the SPY, and you will never, and that's only if it's 100% in it. Okay, I can tell you, I've been running this thing for over 3 years.
Well, yeah, right,
It's
right.
never been above 65
Yeah,
because I'm running a conservative portfolio. So I said,
yeah.
okay, let me create this one. Well, it's all equity. Okay. Guess what? T-bills are not your hedge. The Dow's your hedge. Now, on a day like today, not a bad hedge. Okay. But most days, I mean, when they all go down, there's no hiding here. You'd have to look somewhere else. All the others have some kind of hedge in them. So, like, to me, the other little science experiment is if we go a couple of years and these are doing as well as everything else I'm doing, well, as they said on Scooby Doo, Ruh-roh, like, why
Yeah,
are we making all this stuff so complicated? We would be better off say, okay, you can do some stuff on the outside, but this is as valuable as anything. I mean, as it is, the roar, I don't have it up. Actually, no, I do. Hold on. Okay. One last thing here. Uh, Spy bill. Where is it? Where is it? Oh, I hope that's it. Yes. Okay. So this is the history of that original SPY bill portfolio. Uh, I've written about this in the weekly, the Tuesday weekly letter. So I started this at the very end of 2021. So we had 2022, which was pretty awful. 2023 was good if you were not an average stock. Okay. Um, and uh, then 2024 is kind of more of the same. So in purple here, okay, you can see all I've done is SPY and bill. Okay, you can tell this is pretty much for this period of time, and you can look at this is a conservative portfolio. This is 30% stocks, 70% bonds, fixed allocation. Okay, here is what the average of the top 1,000
Oh, okay.
stocks did. Okay, so here we are.
Wow.
Okay, so I would say officially as of today, SPY bill will have retaken the lead. Let me get rid of this for a moment. Okay, this is the average stock, not the S&P. The S&P is going to be, way up here. Okay, for how long? Who knows? Okay, but what does it tell you? All I've done is once a week. Look, I mean, occasionally, if the market's in a true calamity and I want to make a change, I'll make it on another day. I think I've done it twice in 3 years. But here, SPY bill. That's it. And so I have to ask people, okay, granted, this is very conservative, but it's kept pace with the average stock. Okay. Or if you want to look at it another way, how has it done versus, oh, I don't know, this is, I think, 40% stock and 60% bond. Not bad. It's even competitive with a 60/40 portfolio, I believe, especially after it's ahead of a 60/40. So if I'm beating a 60/40 portfolio using two ETFs in a portfolio that you could literally put, I think, like $100 in this at a brokerage firm. Okay, I don't know if you have commissionless trading, you buy $60 or whatever, $20 of this, $80 of this, and flip them around. Okay, I mean, this is what I do for my daughters. Okay, it's
Yeah.
beaten 60/40 for
Yeah.
3 years. This is what happens when you have a bond bear market and the average stock's not doing that well. You got small caps, whatever. And so again, I'm not selling against myself here. But what I'm
Yeah.
saying is, in addition to all the stuff that people come to us for, like, I don't know, I think it's not a bad deal for $1,500 a year if you're getting it, because look at how long it took just to break even, right? I mean, and matter of fact, I'll do one more thing with this here, okay? Because sometimes I do wonder why we're all, making it so difficult. So let's say that we're at the beginning of a period that is going to be like 2022. I'm definitely not the first one who have said that. Okay. If that happens to be the case, and it's an exact carbon copy, well, this is what you're going to experience. Look over here. Okay. Look over here.
Yeah.
All right.
That's pretty nice.
Okay. And by the way, this is how I've managed money my whole career. I just never oversimplified it like this, but I tried it 3 years ago, even before I started this. Oh, look at this. Okay, we're still within, spitting distance of zero. Okay, this plus a little bit of options work. I mean, I'm not saying it does away with an entire portfolio, but it's why I don't need to own 40 stocks. Okay, and why I don't need to, subtle adjustments, right? Okay, this is a significant point in time because, yeah, they both fell a little bit. All right, this one at the worst case fell 10%. What I always say, worst case 10%. And
Yeah.
frankly, I was probably a little lazy with this because nobody was watching, and I wanted to have an honest track record. Okay, so here, this is when Bill and SPY with the rotation, and by the way, we have it all in the shared research deck, every single weekly score. So that's how I get the back test, and it was with real money. So at this point, where are you? Okay, imagine fast forward a year and 5 months from now. Like, oh, okay, hey, I'm making my way back. I was down 25, almost 30%. Now I'm only down 8. Great. Oh, okay, I just broke even. All right. And imagine if you put some wrinkles into this. All right. And really, I mean, did not catch it until after this. This is the first 2 years of about a 3-year return. And frankly, if I had been on the stick just a little bit more, or even at this point, I would have said, hey, let's take SPY Bill, and now that the market's maybe calming down, whatever, let's put a little money into an out of the money call option, kind of like you would do, like we talked about, in a collar if the stock has gone toward your top. Okay. If you did that and you got this move, this number is now like up here. And how much extra risk have you taken? Maybe I had about $100,000 in this, and I took $500, $1,000 more, and I put it in that option. That option probably goes up 5 or 10 times in a simple, 12%, 15% move like this. So I'm saying, I actually, as somebody I know in the ETF business, I've said, if you ever hired me to run an ETF just to come up with a formula, I probably would just use this formula. Very transparent. However, what drives this? This is what drives it. My technical work and separating high risk markets from lower risk markets, and figuring out where on the spectrum between black and white, which shade of gray is going to allow me to bend but not break and get my fair share of the ups. And with that, I will see if there are any questions, and I will shut the recording.
Yep.